Welcome to TheoTrade. This is Don Kaufman. It's July 31st, 2017. Tonight, a very special evening video for you on expected move. All right, so let's get to a little bit about expected moves here with, of course, the market's massively unchanged today. The Nasdaq throwing off a little bit more volatility. So again, lately we've had a tremendous number of questions regarding, of course, what we term expected move. And I'm going to explain in a bit more detail here during this kind of afternoon session here a bit about expected move. First and foremost, I've been tracking expected move for, it's actually years now inside of a number of products. Because if you think about this as I explain expected move, this is what really matters in markets over here. And when I talk about expected move, you're like, what do you mean? What matters? Okay. So let's go back to some of the basics of the expected moves, and I'll show then what is actually being tracked here on my chart. So we're going to use the SPX in this kind of first example. For those of you unaware, the SPX, it is, what I kind of call the granddaddy of all the products out there. It's a $475 product, and there is no stock on it. Like if I click on here, there's no stock. It's not a tradable instrument. Okay, so what do you have in here? You have options. Now, why do I consider it like the granddaddy of all the products? Why is it so important? What is expected move? We're going to answer all of those. Number one, okay, the number one thing I'm going to tell you about the SPX, and this is something like if you don't have it like on a watch list or something, you should. The SPX drives order flow to a vast amount of the market. Okay, it's one of the primary reasons that we've been stuck in such tight ranges as of late. And I want to show you just that. So before you even start to understand what expected move is, you got to understand why it's so important to look at the SPX. Now, you can be watching this and you might think to yourself, I just trade futures. That's fine. Okay, it moves the futures. I just trade Nasdaq futures. It's fine. It moves the Nasdaq futures. You're like, I don't even know about options. I want nothing to do with options. I don't even know what an option is. And my answer to you, okay, that's fine. But this is what moves markets. And I want to explain why. So I've mentioned this a number of times on different evening videos, mentioned it in our chat rooms here at TheoTrade dozens of times. When I call the SPX the granddaddy of all the products, it's not just because it's a big $2,500 behemoth. Okay, it has a tremendous amount to do with the amount of trade and the order flow going through this. Now, today is an extraordinarily light day. We're not even going to do 1 million contracts in this product, and you're like, ooh, 1 million contracts, but it's almost 1 million contracts in a $2,500 product. Now you think about that in terms of value, okay? Now I know a lot of you are like, oh, that doesn't sound like a lot, okay? Or you have no idea what a lot of contract size is. So let me give you an example. Let's go type in something like Apple. Let's just pull up Apple for a moment. And the reason I'm just going to do this for a second is I just want to compare and contrast. So Apple's a $150 stock doing about 300 and let's call it 350. Okay, a normal day, this is a pretty slow day. A normal day, Apple does closer to 400,000 contracts. So, but it's doing 300,000 contracts with its $150 product. Okay, why does the SPX matter so much? It's because those that trade the SPX, okay, and this is really what it comes down to. Those that trade 1 million contracts in the SPX, and you're like, again, I don't even trade options, man. So the SPX doesn't have any stock. So traders that trade the SPX use the S&P futures as a hedge. So what ultimately happens is if you buy or sell options in the SPX, okay, then they turn around and buy and sell S&P futures as their hedge. Now, when you look at trading, I know everybody always thinks like, trading is somebody went out, for example, and bought 1,000 calls. Okay, now think about this for a second. Somebody goes out and they trade like 1,000 calls. Are they bullish or are they bearish? If you knew that they bought 1,000 calls, this is not like a trick question. Like really start to think about it. Somebody goes out and they buy 1,000 calls. Are they bullish or are they bearish? You go, well, they're bullish. Yeah. Well, how do you know? How do you know if they buy 1,000 calls that they're not short the stock? Now think about that scenario for a second. Why did they buy the calls? They buy okay, the 2500 call. Why did they buy the 2500 call? Because they were short the S&P 500 futures. And buying the call caps the risk to the S&P 500 futures. Could be. By the way, the other thing you have to remember, if somebody bought 1,000 calls, somebody else had to do what? Sell them the 1,000 calls. For every buyer, okay, there's a seller. I mean, the market's pretty easy. For every buyer, there's a seller. And if somebody bought the calls thinking the market's going to go up, that's all well and good, but somebody also sold them to him. And the person that sold them to him probably used the S&P futures, that is, to hedge off the trade. Now, think about the amount of capital that's going through the SPX every day. This is where, again, I will relate this right back down to the volume. Okay, what's the volume? So the volume today, and today's a slow day, is almost 900,000 contracts. Average day it clips just over 1 million. So you look at this and you realize, you're like, whoa, what are you saying over here? I'm saying basically that most of the capital that trades in a marketplace, in the equity marketplace, equity index marketplace, most of the capital that's trading is revolving right around the SPX. Because people go, yeah, what about the spiders? The spiders in the SPX, okay, are relatively one and the same, which means if the SPX moves up, the spiders move up. Here's the irony. The spiders also did, okay, about 1.2 million contracts, which people, that's about half of what norm is in there. Normal in the spiders is closer to 3 million a day. Now, the entire marketplace in options does right now just about 17 million contracts a day. So you're getting like 1.2 million from here, okay? You're getting what? In the SPX, another million thrown off there. So think about this now. If you just do some quick math, you know, there's 2 million contracts of the 17 million right there, and the SPX is 20 times the size of any other contract. Why is it 20 times the size? Because it's a $2,500 product. Compare that to like the XLF. It's a $25 product. Then you have the spiders, the SPX, and the VIX. Okay, what's the VIX? The VIX is related directly back to the SPX because the VIX is the SPX. It's the volatility index for the SPX. It's doing 300,000 contracts. Before you know it, you're going to start to realize that everything on the screen pretty much revolves around the what? The SPX options trade, and the SPX options trade feeds back to the S&Ps. So then it becomes incredibly important to understand the SPX option trades. And again, this is not me telling you like you need to trade options, okay? No, but you need to understand what the expected moves are saying. So for the most part, now we are going to understand what is an expected move. We understand now why we should look at this, because for the most part, most of trade on a day-to-day basis revolves around it, right? You have this behemoth product, and this behemoth product is actually knocking the markets back and forth like a little pinball. So we recognize that. Now it's important to understand what is this expected move? Like, what does it really amount to? What the expected move is, and this is specific to thinkorswim. This is their calculation for expected move. It's about $18, okay, between now and August 4th. What that basically means, it means the marketplace is expecting to move up 18, okay, or down 18. You like that? It's pretty small range given the fact that this is like a $2,500 product. I know it's not the exact, and it's only like up 18 or down 18. You're like, that's not very big of a move. No, it's not. Okay, and it's supposed to stay in that range about 68% of the time. But the expected move, all the expected move is, okay, it's just a derivative of the option pricing. The expected move of $18, okay, it's being extrapolated. It's a big word. It's being extrapolated directly from option pricing in the chain. So the way that to think of like the $18 expected move, the way that calculation is solved for all of you guys that are engineers out there, come on, will all the geeks please stand up? But what's done to calculate expected move is they average these implied volatilities together. They average the implied volatilities together, and they run it through like a little geek of an equation. And the geek equation, and I know people constantly ask this question. This is not the exact equation on thinkorswim, but the way it works is roughly you take, 2470, let's call it 5, right? You take the stock price, You multiply that by times the volatility. What's the volatility? Well, it depends. You have to kind of average the volatility. Let's say volatility in this case is 8%, so it's like 0.08. Then you multiply that by the number of days left, okay? It'd actually be the square root of the number of days left, which is 4, okay, divided by the square root of 365. It's actually calendar days now. So this is the equation, all right, that comes out to what we term the expected move. Now, you guys can run this all that you want. You're not going to find exactly the expected move. The equation on thinkorswim, it's kind of proprietary, and there's not a lot that I've offered to take to my grave, but that's one of them, right? That's one of the things. But anyway, it's an averaging model. Implied volatility is the key component to it, but that's how it's solved for. That's how they do expected move. It's not like the end of the world. And I know if you're watching this, you're probably like, oh, I just tuned out right there when he was talking about math. He talked about math. Anyway, those expected moves each and every week have been absolutely phenomenal. So what I've been doing each week, I started drawing these back in March. I started drawing them, and I push forward every single week. And again, remember, it doesn't say definitively we're going to be inside this expected move. Okay, it doesn't say that. Okay, but what it does say is there's a very, very high probability of us staying inside this expected move. And if you start looking at this, I've even highlighted, okay, there's a break of expected move. Barely, but it broke the expected move. And it displays, if you will, as I kind of scroll back on this in time, it displays every what we'll term breach of the expected move between now, okay, and all the way back to the March timeframe. Now, again, I've actually been using expected move for years and years. What's kind of cool about this is if you buy options or sell options, this tells you right here whether stuff is going to work or not work. There's so many different applications for this stuff, okay? But you can use this as easy as the idea of when we hit the upper end of the expected move, and I'm actually highlighting one of these right now, but when you hit the upper end of the expected move, you expect us to revert back in it, and vice versa is also true. If I zoom in, here's actually an expected move. We started off a week, the expected move is breached to the downside, then we ripped right back inside of it. And you'll see this time and again where we actually breach, if you will, an expected move. And that actually means crack through the expected move and then ultimately trade right back inside of it. Here's another perfect one where just a few weeks back, we ripped through the bottom of the expected move. By the end of the trading day, we're right back in it. The market ultimately is like, oh no, we have breached the expected move. It's not, oh no. And these are not like some Fibonacci's pulled out of thin air. You got to realize something about this expected move. This is not self-fulfilling prophecy kind of stuff, okay? What you have to realize about the expected moves, there are hundreds of billions of dollars being traded in these options. Why do you think we stay inside of an $18 move when it says $18 move? We stay inside that move, okay, because there's what? There is volume, there is open interest, and there is hedging activity. And it's the hedging activity that drives us inside of what's expected, okay? Now, if you take a look at some of the contract size out here, it doesn't look monumental. Start opening up a few more options in here, okay? In fact, I'll even open up all strikes. This is just a routine Friday expiration, people. This is August 4th. It's a Friday expiration. There are tens of thousands of contracts. I'm telling you, there's literally billions of dollars being traded in each one of these expirations. Okay, this is nothing special. This is some August 4th weekly expiration. Look at the contract size. And all this contract size, what does it really amount to? Okay, all of this contract size amounts to one thing. It amounts to a marketplace that really wants to adhere to expected move. The reason I mention this, again, lots of questions. The lines that I'm showing you on this chart are drawn by hand. They're just trend lines. Literally, I go up to drawing tools and I draw these things by hand. In the next few days, you're actually going to see an automated script that we have for drawing the expected moves. Again, automated script that will start passing out. Don't start emailing us yet, okay? I will let it be known when the script is ready for expected moves, but you'll have them then drawn on your chart for you. And that's something that, listen, we're not going to be charging for it at TheoTrade. We believe like every single script, we just give it to you, okay? We'll give you the script. It's, of course, how you're going to use it. So there it is, a little bit about expected moves and, of course, why they're so important in today's marketplace.